Stocks at or near new record highs. Our guest is in the bullish camp, especially for the U.S. market for the rest of 2026. We're joined by Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, thanks very much indeed. You have been optimistic about stocks for a while, and sure enough, they're at or near record highs. The S&P topping 7,000 yesterday. Just remind us why you think there are further gains in store.
Yeah, first off, happy Friday, everybody, and I'm glad I could join today. So thank you for that. You know, we just released, I guess, last week, our 2026 market outlook, and we titled it "Riding the Wave." And we can talk about this for 2 hours, but I'll make it real quick. We think there's a lot of momentum to this market, whether it be fiscal policy, monetary policy, AI, CapEx spending, earnings growth, profit margins, all of these things, Andrew, continue to kind of move forward. And we think likely continue to push this bull market higher. One more quick one. You mentioned I like the U.S. Yes, that's true. But we manage, billions of dollars on the Carson Investor Research team. We do think this is still a global bull market. We would still have, we have exposure to a lot of other parts of the world, as we don't think it's just a U.S. story like it was, say, 2 or 3 years ago. There's a lot of other things that are looking good this year.
You're not. Tell us your thesis, though, on over-exuberance in the AI market.
Yeah, that's a good one because we have some really big IPOs coming out. Last year, we saw the Time Person of the Year, multiple AI leaders. Jensen at NVIDIA was the, which one was it? Financial Times Person of the Year. So there's a lot of optimism. I mean, it is what it is. We're more even weight technology. We're not wildly bullish, but by no means are we bearish. And you see what's been happening lately. I mean, tech has lagged. Like the last 50 days or so, approximately, tech's lagged by a pretty wide margin. How's the market done? Market's done just fine. So we are even weight technology. We continue to be impressed by kind of how the baton gets passed around. And then you see these earnings. I mean, what Taiwan Semi just had to say yesterday, it's a reminder that AI and AI spending is nowhere close to over. I don't know when it's going to end, but it sure doesn't look like it's going to be 2026.
You don't think it's going to be 2020? You think that there's enough, there's still a strong enough case for corporations to invest massively in AI?
We do. I mean, you look at like the large 5 U.S. companies, and it's like over 500 billions expected in CapEx. It was about low 400s last year. It just continues to go higher. And again, it'll be interesting. Maybe talk to me in 2 weeks. We'll have a lot more earnings to discuss. But at least very early, what Taiwan Semi had to say, there's no slowdown yet, and we don't anticipate hearing that over the next couple of weeks this earnings season.
What you do like traditional industrials as well. What kind of stocks are we talking about here, Ryan?
Exactly. The broad-based market is doing very well. I mean, various advanced decline lines are hitting new highs. Again, it's not just about 7 stocks, but we look like at industrials. And you break things down, something like airlines. I mean, listen, airlines are doing really well. There's different parts of industrials. I do like that about industrials because Oh, I just heard the producer. Sorry. Anyway, but you think about it with industrials, there's different parts to the overall industrial market. It's not just Caterpillar, so to speak. There is broad-based strength, and just to keep it real simple, when you have a stronger economy like we think we will here, industrials tend to do a little better. So that's one of our favorite groups in 2026.
Is that partly the massive electrical build-out, among other things?
Oh, that's among other things. Yes. I mean, at the same time, like a company like Caterpillar. All right. I mean, they used to make, big trucks. They are anything but that anymore. It's incredible when you see kind of what these companies just a couple years ago were doing. And now they are leveraging AI. Now they are leveraging productivity. You look at like the stat just came out last week about the revenue per employee on the S&P 500, the highest level it's ever been. I mean, we are in at least the U.S. here, kind of a slow hire, but low fire. If you have a job, you're kind of there. You're not jumping around, but companies are as productive as they've ever been. And we'll find out this earnings season. But we think industrials, financials, like those cyclical areas of the U.S. economy specifically will continue to do really well.
What about bonds? How are you dealing with those, Ryan, right now? Are you keen on owning, say, the U.S. 10-year bond?
Yeah, we're underweight bonds. And honestly, I've come on you for a while saying I'm going to be a broken record here. Overweight stocks, underweight bonds. We absolutely have some bonds in the portfolios that we manage at the Carson Group. But again, the Fed's going to cut probably 3 times this year. Inflation, I mean, inflation's not soaring, but it's kind of sticking around 3%. I mean, so again, a couple cuts. We just still think there's other opportunities. And you think about a 60-40 portfolio. 40% used to be, let's say 10 years ago, put it in bonds. Well, clearly what we've been seeing, what we've been preaching is you don't want to do that anymore. You want bond exposure, yes, but that other stuff, we have some managed futures in there. Yes, we have a little bit of cash, but things like gold and metals and mining, which are just doing incredible. I get it. They're awfully stretched. They're probably going to come back, but those are some things you still want to have in that other bucket of a well-constructed, diversified portfolio.
What trends have you been seeing in this first week of earnings season, Ryan?
Well, again, yeah, it's really early. Let's be clear, but it's been positive again. It's been positive once again. I think earnings expected. If you look at FactSet data, maybe about 8.5% year-over-year earnings growth. What have we been seeing for years now? It's lowballed and things come in better than expected. And we're just optimistic that's going to happen once again. And the other thing, I think that's really, again, it's early, but the broadening out theme, right? We've seen so much growth out of technology the last couple of years, year over year. That's where most of the growth has come from. We get it. But value, little old value is starting to really creep up and impress. And again, those are things like financials and those industrials we've kind of talked about already, maybe parts of healthcare. So this broadening out market is one part of it, but broadening out earnings to see value coming in is impressive. Now, I'll be honest, we haven't seen that yet because those names haven't reported, but that's something we're going to be watching very closely the next couple of weeks.
Ryan, leave us with the final thought. Is there some risk, though, that the market is underestimating, you think?
Oh, there's always some risk. I mean, simply put, S&P 500 is up over 15% 3 years in a row. Only the late 90s was the last time we saw that. So could we have some choppiness? Could we have some volatility? Absolutely. I think we'd still say the biggest risk, though, is a lot of people are still underinvested in a strong bull market. So ride that wave is what we talked about in our outlook, and we're optimistic it's going to be a positive one for investors.
Ryan, thank you very much indeed. And thanks for joining us at short notice today as well. We really appreciate it.
Anytime. I'm around. Happy Friday, and thanks for having me. Anytime. Thanks.
You too. Have a great weekend. Ryan Detrick, Chief Market Strategist at Carson Group.